Welcome to the first panel of the day. Today we're talking about bridging TradFi with DeFi. And I'm excited to introduce our incredible panelists. Maybe we'll start off with some introductions. I'll go first and I'll pass it on to you guys. My name is Nikita Sachdev. I'm the CEO and founder of Luna PR. We're a PR agency headquartered in Dubai, offices in London and New York. Been in the space since 2017, so excited to talk about the topic that we've all been waiting for.
Thank you. My name is Jesus Lander. I live in London. I used to be a director in banking in London, originally from Venezuela. And what I have now is I'm the founder and CEO of Hodl Markets, where we tokenize and distribute hedge fund strategies across different markets.
Hello, I'm Delane. I'm the APAC Managing Director for Nethermind. Nethermind is a UK headquartered and globally remote blockchain engineering, research and security company. We have an 8-year heritage where we started just 2 years after Ethereum began. Today we are, we are over 25 to 30% of all of the Ethereum global nodes run on Nethermind client software. So by extension of that, we're one of the largest infrastructure players in this space. And over the years, we've evolved to be both an engineering, research and security company. And we work with both Web3 native protocols as well as institutional customers on both sides of the pond. Thank you.
Morning, everyone. Happy Monday. Excited to be here. My name is Drew Madhu. I represent Surance Plus. We're the first publicly traded company, reinsurance company, to tokenize a reinsurance contract. We offer 2 security-backed tokens, one targeting 20% annually and another targeting 42% annually. We've recently announced that in our last year's contracts, we're on track to deliver 25% and 42%. And of course, these returns are uncorrelated to the capital markets, not correlated to equities or crypto. Thank you.
Hi, I'm Brandon. I'm the COO co-founder of Denari, and we issue tokenized equities. So things from NVIDIA to Microsoft, anything in the U.S. equity markets. We operate a U.S. registered broker-dealer called Denari Securities, and that's how we're able to offer tokenized equities in a 100% compliant fashion.
Hello, hello. My name is Gideon. I'm a lead business and media growth manager at The Moon Show. We are a user and trading volume acquisition partner for centralized exchanges, currently expanding to DEXs and protocols. 2025, we brought over 23, give or take, 1,000 users to our exchange partners with over 20 billion trading volume. So, yep, thank you.
Amazing. Some of you guys are really in that intersection of crypto and TradFi. So let's get started. We cannot talk about the intersection of TradFi and crypto without talking about RWAs. With stablecoins being one of the best use cases, RWAs have played such an important role in bringing in new users and helping the mainstream actually understand the benefits of Web3. DeFi started off, I'm sure some of you have been in the space for a long time. DeFi started off as very peer-to-peer, decentralized. And RWAs have come in with new regulated structures, still bringing that essence of DeFi. How are the two converging? How are DeFi and RWAs coming together?
Hello. First of all, thank you for all of you for waking up early and coming here. It's a very good question. So when we look at the evolution of blockchain and tokens, it's first the economic incentive and the economic needs, and then regulations and legals catch up. And that's still what's happened these days. I think a very interesting number is that even though Bitcoin is at the lowest numbers that it has been for at least a couple of years, what we can see is that at the same time, stablecoins market cap just hit all-time highs a few weeks ago, around 300 billion. So we've seen finally a decoupling between the real use cases like stablecoins, payments, versus the price of the tokens, which is, I think, is great news because that's exactly the moment in time where you go away from the first use case of crypto, which was gambling to some extent, into payments into how can we create financial instruments that can deliver a performance and services to people that have been under service so far. So I still that will continue. So so you will still see first projects raising, which is happening right now across different regions, Africa, South America, which is where I'm from originally. Catering first for the needs, for the economic needs of the people and the users, and then regulations will catch up. Now, we need to look at always at the countries that tend to lead the regulations, like United States, for example, everyone follows them. Then in this part of the world, it's mainly Hong Kong and Singapore, everyone follows them, right? But I think we will continue that trend, first economic and then legals and regs will catch up.
I'll talk about it from a technology perspective. I think the whole concept of RWAs is not new. We've seen this cycle before. We've discussed this, a few years ago. It's just that alongside, these themes and these ideas, there is a need there, but the technology is finally catching up, right? Technology is evolving. We're at the long tail of innovation, and we're starting to see protocols, frameworks, token standards that are now in service of issuers being able to now start to bring RWA assets on chain, right? And that is that tipping point where we start to see all this flurry of activity. Of course, there's also clarity of regulation across different markets. That's the most, the highest signal. But that technology combined with the regulatory clarity is what is really unlocking this, new trend or new mega trend of RWAs coming on chain. And it then creates this affordance for many, many new people, even outside of the industry, to have inspiration to see what else could I bring on chain, what else could I tokenize, right? So I think that's how I see it from the technology standpoint.
For us, we really see governments trying to figure out what to do about tokenization. As a kind of like a broker-dealer, we have like a front seat with working with the SEC. And the talk of the town really is like, how do we bridge into, how does TradFi bridge into Web3 in a way that doesn't break the current paradigms? And so we see it as kind of a progression, right? So first, the easiest thing to tokenize obviously is stablecoin. And with the Genius Act, that provides a lot of kind of clarity, or at least, regulatory guidance as to how to approach stablecoins in a way that is going to be okay with governments. And then the next kind of like large market is real estate, which it doesn't move very quickly. So like if we think about like the next market after that is equities, which is like $100 trillion. And how do you bring a $100 trillion market into Web3? I think that does require cooperation from governments, and that's why like I think a lot of the current like work now is working with governments to provide the framework for providing tokenized equities that reflect something that is under their kind of purview, right, under their regulation.
And Brandon, Jesus touched base on this a little bit, but why do we need to bring $100 trillion on chain? What are the benefits? What do users get out of what do people what kind of benefits does this propose?
I think it's inevitable. The capital markets have been always looking for something more efficient, right? And so like the US equity system is actually particularly difficult to break into because of how efficient it is. Like you can trade billions of dollars, a day without the market even noticing in many cases. And so like, if there is a more efficient platform, they will go there, right? And so the question is like, what is the pathway for us to get there? But I mean, like as I assume everybody here is kind of aware of the advantage of the blockchain, there's things that it'll affords you that you can't do in the traditional markets. Something as simple as, can I give you a share of NVIDIA? It's like, well, no, not really. Like you can sell it as cash, transfer the cash, buy it in, as stock, and some places do kind of like automate that, but like even something as simple as just me sending it to you, like I need my broker to be online. I need your broker to be online. Like we need to be able to trade it on the market, which isn't on all the time. So I think the more efficient that Web3 becomes, especially with the layer 2s and all that, and better infrastructure, the more that the capital markets will want to move.
So when you say efficiency, you're talking about 24/7 accessibility, you're talking about maybe fractionalized ownership, you're talking about more transparency. Is there anything else that you defined in that realm of efficiency?
So like right now, cash kind of is the common ground. So if you want to do anything with your stock, you kind of convert it to cash and do something with that cash. That's not the only way to do it, right? Like DeFi has shown us you can compose multiple things together. You can compose a loan and convert that into some other asset, and even do that in, like in like an atomic fashion. So these are things that are just unheard of in the traditional markets. We believe that, if the underlying asset has real tangible value, it gives more stability to these types of DeFi kind of operations.
For sure. And Ram, I'm going to introduce you in a second, but just while we have this flow going on, this value actually means nothing if we don't get the users in, right? So getting users in is very important, educating people. And Gideon, that's something that you're really working on. Maybe you can touch base on some of the strategies or how we're going to see more of a retail audience come into the space.
Absolutely. So there are several things that worked in the past that no longer work today. And this has to do with just new practices coming and leaving. For example, let's go back to 2017 or 2020, when so many people made lots of money off of the hype of the market. When there was a lot of money, there was a lot of projects launching, and the regulation was also not there, which made it easier for some types of actors. Now we see much more clear regulation. We see that there is less money. There is a lot of what's the word I'm missing? There is unclarity on what the financial market this year is going to be, and so people are much more careful with where they put the money. The reason this matters is because they no longer react to simple calls to action, like go buy, to go try this financial product, go react to a bonus. Like, it still works, but not in isolation. And this is why we need to combine, and this is something that I'm sure everyone in the room realizes very well, we need to combine the data with narratives and bring it up on the market. So that gives us a stimulus to rethink the formats of content that we serve. And this is exactly what we're doing right now. So in addition to just partnering with exchanges and bringing to light the products that they're launching, derivatives, props, anything really, we also try to build the habits around trading. We try to map it to what is happening on the market. And if that coincides with the RWAs, we do educational bits on that, which benefits everyone at large.
I think narratives are so important. I mean, that's my middle name, like literally what I do. And I think what Brandon said, when we're talking about why it's efficient, those are the narratives that we really need to push out there. I'm going to pause for a second for Ram to introduce himself and Open Ledger.
Hey guys, sorry about the delay and sorry for you guys to come in the middle. I'm Ram. I'm one of the co-founders and contributors at Open Ledger. We've been in the space for almost 10 years, and Open Ledger is something we built in the last 3 years. And the idea started as a company that can solve data attribution in the AI space. We want to make sure that agents and applications that are built on top of any kind of AI model are reasonable. You can actually reason and figure out why these agents behave in a certain way, and we can explain these models. And that's been our product's vision, and we went mainnet last year, and we've been backed by investors like Polychain, Borderless, and many more. And as we went mainnet, we launched our Tokenized, which is trading across exchanges like Binance, Upbit, and all that. I'm glad to be here and talking to you guys. And one thing I want to add probably to the question you asked, why TradFi needs to go on chain, right? That's what we're talking about. I think future of finance is going to be agentic, right? How like 20 years back, we had to move everything to the internet. All of the products, all of the documentation that we do was on the cloud because we were using internet to trade among each others, right? It was not actually physical papers moving around. But the future of finance now is going to be agentic. So it's going to be agentic. Everything has to be on chain. Everything has to be on the internet so that an agent is a digital being and it wants to trade digitally, right? You can't expect to have like human middle grounds in the middle. So if agents are going to be in the future of finance, then you would actually want all of this to be on chain, so it's a seamless interaction right from the payment, right from settlement, right to the regulation that is there. If it's on chain, it just makes it much more easier for agents to interact, right? I was talking to someone, we were all discussing about this, right? I think humans are sort of like a testing ground for like blockchains, where we are not the actual users. The actual users are actually AI agents, which makes much more sense because they would not want to interact with cash, or they would not want to interact with another human. It'll be agent-to-agent conversations, and it's best made on-chain. That's my take, I think, from the AI side. I think if the future is going to be that, it's better it's on-chain and it's more trackable, and you can actually trace and see what's happening as well.
That's a really good perspective. When we're talking about bridging TradFi and Web3, sometimes we disregard how AI is going to make such a big impact. Drew, I had a question for you. Does everything need to be tokenized? Do all assets need to be tokenized? Or, is this just a little bit of a hype fad phase that we're going through?
I don't think everything needs to be tokenized, no. Reinsurance, on the other hand, selfish plug, certainly. Reinsurance is a 750 billion TAM market. It's historically not innovative. Not much has changed over the decades. We see the blockchain as a phenomenal accelerator of distribution for ourselves. We're a small publicly traded reinsurance company. We have access to some very sexy, chunky returns, and we'd like to bring that to everyone possible. I think in the question is, how does the person in Africa get access to this? If it wasn't tokenized, realistically, this random person probably wouldn't hear about us and we wouldn't hear about them. But now through the blockchain and our minimums being at just $5,000, this person too can get access to such an offering.
Do you feel like regulation is a little bit of a hamper? So when we're talking about like how does a person in Africa get access to maybe a bit of a more regulated structure in the US, how does that work?
For ourselves, compliance and transparency is paramount, given the fact that we're governed by the SEC. We're a NASDAQ-listed company. So we want everyone to access our offering, but we do have to play within the corners of the SEC. So KYC, AML, this is paramount. And depending on if you meet Reg D or Reg S regulation, if you're in the US or not, if you're in the US, you do have to be accredited.
Do you see in the future one unified regulatory framework?
I stay out of the politics.
No.
I know, I should not say the R word in this panel too much.
On that, look, as I was saying at the beginning, you always have the leaders, right? So United States tends to, everyone in the Americas and to some extent in Europe tends to follow the States. Everyone then, or many countries in this part of the world, as I said before, tend to follow Singapore and Hong Kong. So, for you to have a unified regulation, then you need kind of just one country, I believe. But what you're going to have is certain basic criteria that will enable then for you as a business to be able to offer products across different countries with small then differences. And also to touch point on the question from before, Eve, about the regulations, right? Like, is this a hamper, right, for progress? And I think, like, at the end of the day, everything has its pros and cons. We do need regulations to protect consumers. Because as we have all seen in crypto over the last few years, is like FTX, for example. If you don't have those, you will have many other FTX. And in this room, in this panel, we are some of the people that tend to push the boundaries. We like to try first technologies, even if there is no regulator or no country that guarantees me that they're going to protect me if something goes wrong. But the reality is most of the world do not act that way. Most of the world, they are used they're used to try products once everyone else around them have tried them, right? And together, You also need to make sure that you have agreements with the governments, agreements with the regulators into how you should act, right? So, so obviously this is costly because you need to bring lawyers, you need to bring accountants, so to make sure you don't breach any rules. But these days is now part of the job in crypto, right? Obviously we have a lot of tech that, and I'm pretty sure everyone knows founders that they build great products and they failed. And they failed why? Because you need to know also have the business side. How can I make money? How can I make sure that everyone who uses my product, as Drew said, they are safe and secure from many edge cases, right, that can make me lose my money. So we as founders, these days, we need to learn how to with the regulations. Again, it costs more money, but it's a necessary evil in order for us to be able to offer products to everyone and provide access, providing efficiencies, right, as you were saying.
Yeah, that's good input. Well, let's move out of regulation a little bit. Let's talk a bit about mechanics. What kind of infrastructure works for tokenization? We're seeing people tokenize on Ethereum. What chains are they using? And how do companies win? Like USDT, USDC, was it first mover advantage? Was it being the first in the market? How do companies or chains actually succeed, and how do they decide what infrastructure to actually build on?
I'd just like to add something. I think we need to have sort of like a universal liquidity layer, which needs to be there. The biggest problem in crypto, again, is because of the fragmentation that are there. Right? There are so many L2s which have been focusing that they are tokenizing assets, but the liquidity is never within each other. The liquidity is always fragmented. We're having this product that's being built on top of us where they're using our tech to have like a no-code platform where you can create multiple trading terminals. A trading terminal that can be used for perpetual dexes that could be trading commodities, another one where you can actually buy stocks, another one where you can actually predict which stock will trade at what price. So it's a prediction market, it's a perp dex and multiple stuff that's being built. And all of this will be sharing a common liquidity. And they're partnering with a firm called Y Network where they're basically liquidity layer. The asset can be still sitting in an L1, but the deed of the asset can be traded among other L2s, right? That's what they're building for. So if we can have like a common liquidity layer, I think that's very important for TradFi to come on chain and have some liquidity, right? Because most of crypto assets have liquidity already because we've been trading crypto for the last 10 years, but most of the tokenized assets will not have that liquidity because it's just new and not many people are trading and they would want to come in, but they need liquidity for them to trade. So if we can have products like this which can unify liquidity together, I think that's very crucial for TradFi to come on chain.
But Ram, where is the liquidity coming from?
So the liquidity usually comes in based on demand, right? That's where any kind of liquidity comes in. I remember this.
I mean, is it retail? Is it institutional?
It's a combination of both. I would just give you an example, right? About 5 years back, when this is back in like I think 2019 or 2020, Binance brought in tokenized assets where you could actually buy US stocks through Binance. But no one actually adopted to it because they didn't really care, right? Because they wanted to trade crypto. But now we are at a point where people are trying to realize, okay, stocks also do well, commodities also do well, and they actually want to trade. In fact, if you take a look into Hyperliquid's recent report, like the top 10 assets that was traded after like BTC, ETH, and Solana, it actually was gold, silver, and other US stocks, right? Top US stocks. And the reason why is because the retail is aware now, okay, I could also invest into these stocks and I can actually make some returns. And also, altcoins have not been doing really well. So that is another option, right? So there is a significant interest coming from the retail to trade stocks. That's where I think there is large volumes. And obviously, institutions as well want to hold tokenized assets. For example, there are institutions across the globe. There are institutions in Korea, there are institutions in India, there are institutions in other parts of the world which want to get access to US stocks, right? They might not be regulated, but they would want to buy a US stock, and they could do that by buying a tokenized asset. So it comes from both sides, and I would highly see retail coming forward and start trading as well. And as we are also kind of like experiencing a bear market, I think there is a lot of retail interest towards tokenized stocks and tokenized commodities.
Delane, you were going to add something in when I was talking about infrastructure.
Yes. Yes. So for Nethermind, we are a company that has worked alongside many of such startups that have launched and failed and are still around as well. And we walk along with them on their journey. A lot of them, when their starting point is, it depends on their goals, right? It depends on the market where they begin. It depends on what is their point of leverage, right? Whether you as the company founder or the protocol or the project has a certain base of users that you already have captive, or you own a certain distribution network. There's no one size fits all, right? So let's say you launch on Ethereum, and you can choose to then bridge to choose to then onboard or integrate another layer 2, right? Depending on your roadmap. How do you define that roadmap? Ultimately, is at the end of the day, what kind of information and what kind of advantage do you have that you then choose to go to that particular protocol or even bridge across to another L1, right? At the end of the day, what is in your back pocket that allows you to extend, your distribution.
Do you think that's just adding another layer of complication? Like when we're talking about bringing new users into the crypto space, do you think when we're talking about interoperability or these layer 2s, like is that adding more complication? Does the end user actually need to understand how the tech works? Like sort of like when we're Apple Paying, like we don't know how the NFC technology works. Like, does the end user actually need to know how the tech works, and is adding like an L2, another layer of complication?
I think the beauty of blockchain, and now it's an extension of AI as well, right, is that now the end user is offered a wider spectrum of optionality, right? If you are someone that I don't want to know about what's happening on the back end, I just go to a platform that gives me a great UX, and I abstracts away all the thinking that I need. I can talk to the agent and it gives me advice, and then it rebalances my portfolio automatically. That could be while I custody my own assets, right? That is fully self-participatory DeFi through some kind of regulatory with some regulatory protections, and those kind of platforms are also emerging, right? If you're a lot more sophisticated trader or participant, you can make decisions on your own, and you can compose your stack. You can compose your stack with platforms or partners, or even with agents in the future. They can compose your stack with your upstream prompting. So,
and when we talk about the infrastructure, I think we need to take into account the end user in mind. In crypto, for many years, we built technology based on how cool we think it could be and what problem we think in our minds could solve. So, for example, I just came about because, Ethereum is not scalable, so one day, once payment companies or other financial industries companies are using blockchain, therefore they would like to have cheap settlement, right? Now, in reality, when you look today at institutions, and speak a lot to banks and asset managers, yes, you do have cases like BlackRock using some layer 1 or layers 2, to deploy the products. And when you speak to most of the banks in Europe, most of the banks in the US, they're not using public blockchains. Some of them are putting a bit of marketing on, look, we might deploy something here and there on Ethereum or in Solana. But the reality is they are developing between themselves like private blockchains. One of the blockchains that has the most buzz in terms of institutional adoption count these days, they haven't been fighting for TVL or number of users. They actually just have made sure that big institutions are on their chain. So because they try to understand a lot their how they think, what the problems that they have, and then that's why you see also these days Canton announcing constantly like new banks and new asset managers deploying, right? So I think we're in a moment in time where we need to look deeper into how do we make sure Web2 users use the technology without even knowing that they're using blockchain. They don't need to know there is tokenization. They just need to know that they have suddenly access to a new product like hedge fund strategies or insurance or stocks, and they don't really need to know that, they happen to be then powered by blockchain, right? That's how I think you actually bring new users to Web2. That's how you bring new volumes to DeFi. That's how you grow again from where we are right now. Because as we haven't had the users in mind, I feel like we are stuck as an industry right now, to some extent.
So for Denari, we actually approached it because technology has never really been the limiting factor. Our approach has been to use the technology that we think follows both the current systems that operate in TradFi today, but also what we think is something that the regulators have, they feel like they have something to regulate. Because there's a number of like rules for US securities that are impossible to kind of enforce unless you operate, for example, in a layer 1 environment where you have control over things like latency. The one that we have been focusing on has been, there's this rule that when you issue a trade for a security, you're getting the best deal possible, the best price. And so our approach to that was like, okay, well, if that's true, then in a blockchain world, that would be like an L1, where all of the orders from any of the retail chains gets funneled up, and then you can match against any order on any blockchain, right? And so we modeled it as like, okay, well, this, in TradFi world, this is like one of the US exchanges, and so we operate kind of like an L1, like one of those exchanges. But exchanges are operated kind of like almost like in a peer-to-peer way, where any broker-dealer has equal access. And so our L1 chain is built with the idea that it's kind of like a shared ownership for any broker-dealer who wants to plug in and get equal access. And that's where we can apply the regulatory rules that make it similar in structure to the existing environment.
That's amazing. Guys, sorry, I wish we could chat longer, but we need to wrap it up and start the next panel. So thank you very much for listening, and thank you so much to our incredible panelists.
Thank you, everyone.